Black Swan.
Hello traders, welcome to part 2 of our advanced market structure series. We're going to look to build on from the first installment and start to look at some of the finer details within structure. So what we're going to be looking at is fractal markets, and I'm going to be talking about how the market is fractal. And what I mean by this is order flow is order flow. Structure is structure. We don't need to attach a time frame to this idea. The way price moves is the same on every time frame. So when you truly understand this, you come to realize you can trade for daily the same way you can trade the 5S. We're going to be looking at multi-time frame structural analysis. So I will be showing you how I build a top-down view of the market to form a directional bias, and how I will take this high time frame directional bias down to the lower time frames to execute trades within a high time frame structural play. At Black Swan, we are intraday traders. So what I mean by that is we take the bulk of our profits within the day. If we are holding overnight, it's normally with small amounts of volume, just to see if we can reach our higher time frame objectives if they've not been met within the intraday session. So I'll be showing you how you can take advantage of the dynamic between the 4H and 15M to begin to build really robust trade ideas you can execute yourself within a live market. So fractal markets. What do I mean by the market's fractal, price is fractal, and everything is fractal? Well, let's pretend we're the composite operator, right? We're not exactly sitting at our office thinking, well, the next 4H candle, when that comes, I'm going to put a million lot sell into whatever market it is I'm manipulating to meet my economic objectives and to deliver price to where I need to see it. No, the composite operator, the entity that runs price in markets, does not care about time. So in effect, price is unaware of time and time is unaware of price. So when we look at time frames in any given market, we're simply getting a depiction of how the flow of orders occurred within that structure of time. It's just an illustration of order flow. And within that, you have your structure, right? So there is no difference between the 4H, the daily, the 1S, or any time frame. And what I mean by there's no difference, each time frame will deliver us the same sequence of events. We'll get our swing lows, our swing highs, we'll get ranges of price. Within the range we'll have internal structure. This is where we see our substructure and minor structure points being created and being swept. It is the same on every single time frame. So to progress further within the realm of viewing structure in a more advanced critical way, what you really need to have at the forefront of every piece of analysis you do, every piece of refinement you want to make, is that price is fractal. So it's being delivered the same on each time frame. So when you take this concept and integrate it with structure, integrate it with supply and demand, integrate it with your confirmation technique. At Black Swan, we use change of character, which is just simplified Wyckoff. When you merge these all together, this is when you can start to explore the idea of doing higher time frame structural plays, but getting a lower time frame entry on the 5S the 1M, whichever your preference is. And equally, if you're coming from smart money already and you already understand that price is fractal, but you're struggling to refine your entries down from the 1M to get yourself onto the 5S to really squeeze your stop loss to maximize your risk to reward. Well, it's the same thing you need to apply how you enter on a 1M. The same way you enter on a 1M, you refine it down to get your 5S entry. So in terms of picking the right alignment areas to really get involved in these great trades, we'll start to cover more in our supply and demand series. But what I want you to take forwards as we progress throughout this mini series on advanced structure is everything is playing out at the same time on every single time frame, and what you will get is interaction between each time frame. And what we find best at Black Swan as day traders is the dynamic between the 15M and the 4H, using 1M as our key order flow time frame and using 5S as our trigger for when price realigns and we see the right alignment within price to utilize the power that fractal markets, that the fractal nature of price gives us to get involved with 1 pip stop losses. So let me just run through some time frames now, and you'll see exactly what I mean in terms of structural and price delivery. Because again, like I said, if you can trade the 4H or the daily as a retail trader, then you need to ask yourself, if everything is being delivered the same, why can't I trade the 1S chart? And there's no reason why you can't, as long as you are using the right refinements and have the right approach to get involved in the market and the right edge constructed and tested, so you have the confidence. There is no reason why you can't refine down again. And if you like I said, if you're already trading smart money and you're aspiring to refine that little bit further and to get yourself in on the seconds, it's all about the power of fractal price. Okay, so yeah, if we look at the daily, look at this piece of structure here where we got our lower highs, lower lows, lower highs, lower lows, lower highs. You know, this is a textbook piece of structural delivery, right? We've got a bearish market, it was trending down, and within these legs of price we have these internal structure points, what can be defined as and characterized as substructure, minor structure, again more internal structure points within our swing points of structure. Okay, if we go into the 4H, just look at a piece of structure in the 4H. What do we get? Well, we have our highs, lower lows, lower highs, lower lows, and within this leg of price here, if I just mark it out, what do we get? Well, we have our internal structure points, what are built for liquidity within each structural leg to help us get to the next structural leg, because we know the composite operator needs to build orders and liquidity as it moves price. Great, this is the 4H. Let's look at the 15M. What have we got here? We've got a bullish cycle, yeah, counter trend move within the 4H structural piece. We've got our highs, lower lows, higher highs, sorry, higher lows, higher highs, higher lows, until we realign here. What do we get? Well, we get swing points. Then we get internal points, what are built for liquidity purposes to get to the next structural leg. And here we see a realignment of order flow. Okay, so we know the higher time frame is bearish, and we look at order flow switches as a way to confirm that price wants to realign, but it's literally the same. So if we go down to the 1M, price is literally delivered to us exactly the same. We have our swing highs, our swing lows, swing highs, and within these legs of prices, we have our substructural pieces, our minor structural pieces of structure. Right, if you think about it, what's the difference between the daily chart and the 1M chart in terms of how price is delivered to you? There's absolutely no difference. And this rule applies all the way down to the 1S. I'll just go to the 5S chart here. But what you need to consider is obviously the nature of being on the second charts. Order flow and structure is going to switch up extremely fast because it's bouncing between structural points on the higher time frames. So you need to be really, really fast with how you react to price. Again, trading the seconds is just all about picking the right points in price where you anticipate realignment on all time frames and simply just hitting the button to get involved. But it's all driven through this concept of price is fractal. The market is fractal. Structure and price delivery is exactly the same on every single time frame. The important piece is to learn how to refine and what areas you pick to get involved. Because, you know, I'm not going to lie to you. I'm not saying you could just jump on a 5S chart and start trading every single structure break. That's not how it works. We use multi-timeframe structural analysis to understand what points in price we need to wait for before we think, right, now it's time to jump on the 1M. Now it's time to jump onto the 5S. And in the next module, multi-timeframe structure, what we start to do is looking at how we look at a market from a top-down point of view and how different time frames of structure will interact with each other, and you can start to build this story for yourself and really understand where a market is going and developing a robust directional bias within the market. So, multi-time frame structural analysis. How do I conduct a top-down? Once a week I will go to the monthly and work my way down to the 15M. And before each trading session, so I trade the New York session, I'll do a top-down from the daily down to the 15M. So I've got a strong directional bias in the market, because if we think about the cost of implementing the higher time frame structural points, if you follow them, just follow structure, you can develop high quality trade ideas, what you can then go on to execute and deliver some good RR for yourself. So this is how I would do a top down from the monthly. As we can see, it's a bearish market. And we know that because we had a low here, what created a high. Creating a low, however, you could assume it was bullish here, but the high gets respected initially. Then this new high goes to break the low. Right, so structure has shifted because we've had a break structure to the downside. And I would just be marking this out as I go along. Cool, so this high here goes to break this low. Creating another high here. Then this high takes this low here, giving us our low, new low in the market here. So what's really important to note is this high here is not swing structure. Although this was the last high that took our low, if you see here, the low that came after this high here did not take this low. So the strong high in this piece of price action is here. Okay, so if price was to run the low and trade back up, this high could actually just be internal structure to this range to be used for liquidity. So it's really important when you're plotting out your swing structural points that you're only using the highs and lows where the origin of the breaker structure comes from. Okay, because it's really easy to think that is our high, but this low was never taken. This low never traded below this point here, meaning the origin of our move is this high. So as you can see, after we traded down below this structural point where we've had impulsive price action, giving us a change of character here. Now, a change of character is how we confirm trades. All it is Wyckoff simplified. So we can think of this as a period of accumulation because we have traded down, 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 and now we're in premium. So it's reasonable to assume the monthly will undergo some form of retracement to collect liquidity in the upside part of the leg. Yeah. So that's great. So we know we've got a bearish market and now we're kind of trapped in this range here. So we see price trade out of this range and back into this range of price here within our structural point. And price trades back down. So what do we have? We have a new high here. So at this stage, you could think, well, this is going to be taken. We trade down. We fail to break the low. So it's reasonable to assume this could be our first sign of order flow shifting, and potentially the market's going to go bullish. Yeah, but we trade up and we're unable to take this high. So what's weak in this situation here? This low is weak. Yeah, but this high is also weak as well. So in these situations, we have to let price play out and really show us where it wants to go, because several things can happen here. We can see this low be respected and this high is just being put into the market for liquidity, and it's just tempting all the sellers to enter, and all it's going to do is just respect this low and fly off to come release some of the positions higher up in the leg in more premium pricing, because right now within a weekly view of the story on EU, price is cheap. Yeah, and when price is cheap, people tend to buy because it's better to sell at a premium than it is to sell at discount. However, this might not be the case. This low could be our internal liquidity point, what's going to get run, right? And what we could see is the low get run. Maybe we respect the extreme of the range, trade back up, then come take the high, or price can simply melt. So it's really important when you're doing your own multi-timeframe structural analysis, whether it be a top-down from the monthly or just a top-down from the daily, you need to kind of say to yourself, right, well, if the picture's unclear, because right now the picture is unclear, we are trapped within this range of price. Yeah. You need to think, well, what could happen? And what evidence that is being shown to me on the charts supports my theories. So I've just laid out what I believe could happen, and my reasons are that both this high is weak and this low is weak. We know weak lows and highs get run and strong hold. Right now it is hard to really determine which is strong, okay? But we know overall the market is bearish for EU on the monthly. So, you know, it's more reasonable to assume that the low is going to get run. Maybe we respect the extreme of this range, or perhaps this is the move what's going to break structure to the downside. So from an intraday point of view, this does not matter too much, because these moves take years to play out, right? Our job is to take trades within the intraday session and get paid on the day. But we need to understand where the market's going over the long term. So when we hit significant points of interest, we can react accordingly, because as you can see, EU right now is trading down into the extreme of this low. So everyone's selling, yeah? Because the 4H is bearish, the daily's bearish, everything's bearish. But we might come and trade into this extreme that's yet to be hit. And before anyone understands what's happening, you've got everyone trying to sell. And this could be the point where the composite operator decides to inject 1 million lots of buy orders into the market, because they have obtained enough sell orders and they have developed enough available buy side liquidity to easily buy out this range, because everybody's selling. So if everybody's selling this market right now, all their stop losses are above all these highs. Okay, so if they buy hard, this is just going to get run, and the liquidity is going to be available for price to have that shift. So yeah, we've established that the monthly is bearish. We're trapped in a range, and we're coming up to a significant point of interest. So, I mean, if you trade EU yourself, let's see what happens when price comes into this point of interest, yeah? So once I've sort of picked apart the monthly, I will drop down to the weekly. And what I find, the monthly and weekly, the story is normally quite aligned. Yeah. So on the weekly, what I'd be looking at is, okay, so we've traded up into this high. We've respected it. We've had a shift of order flow right here. Order flow and structure have realigned at this point, because it is a bearish market, yeah. And we did trade up into the leg of price, and you know, it is reasonable to assume price could trade down. And what we've seen on the weekly is key points in order flow, and we're going to talk a lot more about order flow in the next video in part 3. But we've seen order flow fail to support a bullish argument for EU at this stage of price, and then we get the sell down. Okay, so I would simply be looking at this low, this high, this low, And when you get to this stage, when you get to the weekly, the daily, this is when you want to start zooming in on what's happening now. And this piece of price action is what is happening right now. It's good to know what's happened in the past, but again, from an intraday perspective, we don't want to focus on it too much. So what's happened here? We have traded up. Really nice bullish price action. We get a first sign of order flow failing here, and we'll learn more about that in the next video. We respect the low, yeah. Trade back up, and the high is respected. So we know the high is most likely strong, and it's going to take the low, and we take the low. Trading back down into this extreme level of the range. So it's great. We can clearly see that this is a weak bearish push down on the weekly, and we've taken out significant points in structure to sort of invalidate a current bullish case for EU. So at this stage, I'll be going down to the daily, and it's the daily where we begin to dive into the detail, because as day traders, I'm mainly focusing on 20 to 50 pip moves, and you know, you're really going to get the high quality trades by focusing on the daily and the 4H and understanding what is realistic within the intraday, because I like to book the majority of my profit within the session. If I'm going to leave volume overnight, it's going to be reduced volume, significantly reduced volume. Yeah, so as we can see on the daily, it's aligned with the weekly. It's very much bearish. We've had a low here, created a new high. This high has taken this low, giving us a breaker structure, giving us a new low where price traded up, was unable to break, but it did take liquidity from the high. And we can see that represented as the wick, what traded above this high. So what does that mean? That means price went above this protected high to collect unmitigated orders. Now, the only entity who can do that is the composite operator. And they will do this to take the last bits of liquidity needed to fuel the next move. So in this situation, the stop's above this high. Because think about the millions and millions and millions of traders what are selling this market, and the amount of stop losses, whether in the form of people who have been selling all the way down and trailing their stop, or new sellers what have entered the market when price impulsed down from here. So it's reasonable to assume we are going to remain bearish until we start to see the signs of order flow shifting to potentially give us a bigger retracement on the weekly, or we could just continue bearish. So here we have our breaker structure. Structure's held here. We've seen liquidity's been taken, so we're not counting this as a structure break, because what we need to see for a structure break to be valid is the candle to close above or below the structural point. So what does this mean? Think about this from a transactional point of view. If price cannot close above or below a point in structure, it means there's a vested interest in keeping price below or above that level. It's only if buyers or sellers are able to close their price above that pricing level that we can consider it a breaker structure. Until we see that, these wicks, we consider them as liquidity grabs, and they merely happen just to collect liquidity and to take out any early sellers or any sellers who have been selling the market for some time. So as you can see here, the price was initially respected. Well, actually, I think it's swept by about a pip or so. And then you probably had a whole wave of sellers who came into the market to try and sell this down from here to try and break this point. But the composite operator took them out their positions and then caused the real move. So as you can see, we've traded below this low, but it's the same here. We haven't actually had a body close below this point yet, as this daily candle is still active. So what we need to see is this candle close below this low, and we can count it as a new structural break. If it does not close below, then we cannot count it as a structural break, just a liquidity grab, until we get new information in the form of the next daily candle breaking it, or price could reverse. So very much my directional view of this market right now is bearish. I have a demand level here where I expect maybe a counter trend play to occur. That this could take weeks to roll out, but you know, currently it's all about sales. Yeah, it's a bearish market, right? So I'm satisfied with my view of the market on a daily, and I'll begin to go down onto the 4H. And as we can see, the 4H is obviously aligned with the daily, so we've got really clear bearish structure in place. And we can see we've got our high, low, we've got our high, new low, high, low. Yeah. So as we can see, we are now in an interesting point in price, and now this is where you really can begin to build a good view of direction and what to expect from your trades, because depending on the makeup of structure depends on the type of trade you're going to be looking for, whether it's pro trend or counter trend. It's best to look for the pro trend moves, because counter trend, everything is really against you. So you need really key confluences to trade counter trend. But right now, you know, this market is all about sales. Yeah. However, although we haven't closed below this point on the daily, so we can't count it as a daily breaker structure, simply a liquidity grab. Right here, we have broken structure on the 4H because we've closed below this point. Yeah. So, you know, what can I expect? Well, we can expect maybe this high, what has a unmitigated supply zone. Again, if you don't know too much about supply and demand, do not worry. It will be covered in a good amount of detail in its miniseries, what we are releasing after we finish the structure miniseries. So we can expect, because we've taken a week low, that price will come back into our Lego price, because the composite operator needs to develop more substructure, more minor structure to create our new swing high, to then take price back down to potentially break this low. So we can do two things really. We can see if it plays out and see if price trades up, then look for sales. Or we can think, right, well, I've got a 140 pip range here until I expect price to realign bearish. So I'm going to be doing some counter trend buys. And what I need to see is order flow to shift. And you know, that would be in the form of a 15-minute breaker structure, because if we get a 15-minute breaker structure, what can we expect? Well, if we go back to our diagram from part 1 in this series, where we had the 4H retracement back to the low, we had a 15M bearish cycle. So, you know, my view right now is if we get that breaker structure here, that we get our 15M bullish cycle until we see a realignment of the order flow on timeframes to then sell back down. So right now I'll be thinking, okay, so I've had my first sign of order flow shifting here in the form of change of character. Now, it's really important if you already trade change of character and you understand what it is. It's not a silver bullet. It's not some powerful source. Yes, it's very effective, but all a change of character is the first signs of order flow shifting. And we use order flow shifts to confirm entries, right? So a 4H order flow shift in this change of character will, if it's going to stick, we'll see a 15-minute breaker structure. And then if we see the 15-minute breaker structure, we can look to get involved. So if we go down to the 15M, what do we see? Well, the story here is quite interesting. We've got a low here. Well, it was a weak low because it's run, and our high here. We had a new low, and I actually traded this today. So if you are in our Telegram, you would have seen I sent out the analysis that I was expecting sales from here, and it was delivered perfectly. So I was able to net 49R from that sell. However, I was sort of anticipating this low to get run at least, but to maybe trade down deeper. But what have we seen? Well, we haven't seen a body close below this low on the 15M. We've only seen a wick go below. So we know that all the composite operator has done here is take the liquidity from this low, and then we see this massive impulse to the upside, taking all of this available buy side liquidity. Now, if you're confused by the term of buy side liquidity, I will be covering liquidity in more depth in part 3 of this series. So that's fine. We see an impulse coming up, taking all the buy side liquidity. We can see we got a 4H change of character. And really, if I wanted to get involved in this market, I need to see real intent on the 15M. I need to see 15M commit, right? And what does that look like? Well, it looks like the structure shifting. So, for example, if in Asia, we could see this high point get closed above on the 15M, like I closed it above, and maybe London sells off tomorrow back into discount pricing into our new leg of price, and we could potentially see some buys up. However, if price is unable to close above these levels, unable to trade above here, I'm not going to marry buys simply because we did not trade close below this low. I'm going to wait for new information, and I'm going to let price tell me what it wants to do. But right now, in terms of directional bias, we know we are bearish on the monthly, weekly, daily, on the 4H, but we know we have just taken a 4H low. So because we've taken the low, we must trade back into the leg of price to create more liquidity to take the next structural leg. Or this simply could be the start of a much larger retracement because we have seen EU be bearish for a considerable amount of time. But as day traders, all we need to concern ourselves about is what's going to happen in the session. So if I see something like this in New York tomorrow, leading up to New York, sorry, I will be happy to buy. So if this does happen, yeah, I'll do a recap on it. But equally so, we could respect this wick, what we're doing here, and we're seeing a slight shift in order flow, and EU can just continue to be aligned with its bearish order flow, what we're seeing on all the other time frames. Take this low and trade here, and off we go to hell. Yeah, I hope that has some value. If you have any questions about what I've covered in the multi-time frame structural analysis, please just send us a message on Instagram and we'll get back to you when we can. So as we close to wrap up this this installment, I just want to run through why we used the 4H and 15M to form our trade ideas and to use them as a foundation to get intraday trades. And this is something you're going to need to go do yourself. Go look at the charts yourself. So I've just got a bit of price action on EU here. Yeah. So obviously we just did the top-down analysis, and we knew this was a bearish market when it was going through this phase because it was aligned with the daily and the weekly, and it's aligned with the monthly. So we know it's a bearish market, yeah. And we got this 4-hour bearish price action. What was playing out? Okay, so I've marked out 2 days worth of price action, right? So it's reasonable to assume that as we traded into, if we just replay this. So what happens here? Well, we trade down, yeah, breaking this structural point, and we know the daily has just injected into the market, and we can expect the daily low to get run. So 4H and daily are very much aligned. Price trades up into this supply level. It's unable to go any higher, and we see an order flow shift happen on the 4H, and that is characterized by this being run, and this low going. If bullish intent was to stay in this market, price would respect this and fly off, right? But it didn't. We traded through, and we respected the high of this ever since. Yeah, price was unable to break it again. So obviously we've traded into this low, but we know this low is weak. So what happens to weak lows? They get run. So we trade back up into premium pricing, but we know this is our suspected strong high. We've had an order flow shift. The low is unable to go any higher. This low is not being able to break this high. The daily has just come into the market. So, we can expect this low to go. So with that information, we know we can get shorts from up here. We can use supply and demand to sort of get involved in the market and to understand our correct levels. And we'll be covering supply and demand in greater detail in the next series. But we just let this run. So when the low goes, we have about almost 2 days worth of price action, yeah. In fact, actually, sorry, the week started here. Okay, so we have about 2 days worth of price action. This is where the market opened on the Monday. We trade up, respect our strong high. So from this strong high here, we could have got into sells. And we could have got into buys here. Yeah, because although we've held the low, although we're expecting the low to get run, sorry, we see a really nice order flow shift here. And so we could use this as an opportunity because we've just taken a 15M low here. So we know when we take a low, we need to come back into the range to collect orders, right? So we could have taken a counter trend buy here. Price respects our high, coming off our 4H high, what is respected our supply level really nicely. So we could have got sales here. We created a liquidity pool. I'll cover that in the next video in more detail. So we create our liquidity pool, what gets run. Again, we respect the high. So we could have loaded up more sales here. We see a nice flow in order shift changing here. So, and we have a nice supply and demand flip, what we'll be covering in the later series. So yeah, great. So we could get into sales here, and we can sell all this down. That's just 2 days worth of price action using the 4H and the 15M together. Now you're probably wondering why I've not spoken about the 1M or the 5S really at all in this installment. Well, the reality is every trade I take, I'm using 4-hour structure. So I'm understanding whether the 4H is bullish or bearish and whether it's aligned with the daily. So if the 4H is bullish, is the daily bullish or is the daily bearish? And where can I expect price to turn around? Or if we're aligned, how long can this continue for until we can expect some sort of pullback? Then I will see if the 15M is aligned with the 4H or is not aligned. So if the 4H is bearish but the 15M is bullish, I need to understand the purpose of my trade, whether I'm going to wait for realignment or look for a counter trend trade. And what I want you to do, if you've watched this far into the video, is go back through your charts, go into the pair you trade, go on the 4H, mark out your swing structural points, then go into the 15M and mark out your swing structural points. Then start to look at the amount of opportunities what are given by following the 4H and 15M. There is an abundance of opportunity in these markets. And the way you trade the 4H and 15M is doing exactly what I've explained. Understanding that the market is fractal. Understanding that we are unfolding price the same on every single time frame, but there's interaction between each time frame. And this is delivered through multi-time frame structure. Understand that you need to do a top-down analysis on the market you want to trade. So go from the monthly down to the 15M and backtest. And what you'll start to realize is just by following the 4H and 15M with a top-down view in mind, you can start to develop high-quality trade ideas just by using these two time frames. Now, if you want to see more trade recaps on how we use these two time frames to actually execute trades in live markets, just go to our Instagram or look at some of the trade recaps we have on the channel. And if you want to learn in more detail, then join our Telegram, and the link is in the description. But yeah, I really hope you enjoyed the second installment of this series, and if you've got any feedback, please leave your comments in the comment section. And we'll be bringing part 3, what we'll be focusing on a lot on liquidity. That'll be coming really soon. Thanks for watching.